Here's a brief overview of what I'm going to discuss today, a bit about me and my passions, an overview of pensions in the UK and Australia. I'll do a little compare and contrast and talk about things that are different, and then I'll talk about some things from the DB land that I think might be interesting in a DC context. I'll make some investment observations, and then finally, before I wrap up, I'd like to talk about next generation pensions and where I think the industry may be going. So, without further ado, as Steve said, I've been lucky enough to work on both in Australia and Singapore and the UK, and the last 5 years have been very interested in both managing the DB money for British Airways pensions, as well as being on their trustee scheme for their DC scheme. That's the open one for those people who've joined in the last decade and don't have the luxury of a DB pension. Since I've relocated back to Australia, I've only been here 10 days, so just enjoying the lovely winter. I've founded a wholesale advisory business called Edgehaven, where I'm advising clients on superannuation, and at the moment my first client's Royal Mail pension plan in the UK, so truly a global business. So I'm passionate about the members' experience, about whether that's investing for them as best as I can, or for improving scheme design. So without further ado, this is some features of the UK pension scheme. Hopefully you'll recognise it. The UK is the third largest pension scheme in the world, with 75% of the assets in DB, 2.7 trillion US dollars, and the fastest growing component of it is the DC. Today we're witnessing the demise of DB schemes, and we have been doing for the last, say, 10 plus years, as the door's being slammed shut for future accrual and the industry's turning and switching towards DC schemes. In fact, the initiation of compulsory DC, it's not actually compulsory because you can opt out, it's called auto-enrolment and you can get out of it, only happened in the UK in October 2012. So you can see that they're sort of 20 plus years behind where the Australian scheme has been. And the object of auto-enrolment was to enrol the other 43% of people who had not yet been given a private pension scheme, either because they were lower paid workers, contract workers, or they worked for smaller companies that didn't have the provision of a pension scheme. So we should applaud the Australian system for being early to close DB, early to start DC, and early to grow contributions for the average worker. This kind of headline, this says pension deficit set to jump by 100 billion. This is typical of the sort of press that the DB scheme gets, and I should know, working for British Airways, which is one of those schemes that seems to get in the press for some reason, quite a lot. Newer accounting rules means that companies now being made through their accounts, as you know, to provide fully for the final salary promises that they've made to their employees over the years. The price at which they're having to provide those contributions is now much higher than ever envisaged when they make it, due to the low interest rate environment and financial repression caused by QE around the world. So we see lots of these woeful headlines about DB, which causes people generally to castigate the industry, and generally people who've switched to DC to feel slightly smug and slightly well off in comparison. And the next slide shows quite graphically why DB schemes have been in so much strife. This chart shows a decade chart of the long index-linked gilt, so maturing 2035. This is a matching asset for the DB pension schemes in the UK. There's only 400 billion in existence of index-linked long bonds, and probably a demand for them is about 1.1 trillion, so obviously everybody wants these matching assets. As that interest rate has moved lower, then DB companies have had to come up with ever-increasing funds to bridge the gap between the assets and the liabilities. It's said that for every 1% fall in interest rates, the liabilities go up 20% and the assets generally go up 6%. So you've got a massive gap that you have to fill. Financial repression has obviously exacerbated this and taken it to new lows. Hence, everyone here believing that the bonds are of poor value. However, there is a silver lining in this if you're a DB member. The contribution rates for DB schemes reflect this dire situation, and if you're in a DB scheme, it's likely that never mind 9 or 12%, your employer is in fact contributing between 20 and 25% of your final salary each year to make good that gap. Of course, DC schemes also suffer from the same pain as this. Low rates means that it's hard, assets can't grow at the same rates, and pension, people need to save up to 1 and 2 times as much as they previously did just to get the same replacement pension. But sadly, even though it's the same for DC schemes, it's never in the press. Very few individuals outside of the pension industry are even aware that this is going on. And those of us in DC schemes look on with envy at those with DB schemes, where things like 66% of final salary are being promised and funded, and meanwhile we're putting away 9%, knowing that that's never going to be enough. I wonder if you've yet told your members that if the rate of return decreases from 7 to 5, that they will need to save 50% more to get the same level of income. Perhaps not. Turning now to the features of the Australian market. This is the 4th largest market in the world, with 1.7 trillion in assets, and obviously growing fast. The last decade is about 9% growth rate. The industry obviously has a heavy DC focus. 81% of the assets are DC. However, the industry focus seems to be, as we've discussed here at this conference, only aimed at producing a pot of money at retirement. The DC balances are still not yet meaningful enough. We're 20 years through a 40-year program to produce a decent income in retirement. I'm told that the average DC balance is around $80,000, which is generally taken out as all cash. Given what I said about the low rates of returns, we're all very aware that 9% is really not adequate to provide a reasonable income in retirement. The members in Australia sadly don't seem to have any tools to manage longevity risk, and they run the very real risk of running out of money in old age, or of falling back onto a government safety net that was really simply a last resort. The Actuaries Institute of Australia recently produced a white paper on the longevity tsunami that is about to hit Australia, estimating that 25% of the population will be over 65 in 2050, compared to 14% now. Aged care costs as well. For those who live longer, there's no policy solution in Australia for members who have to move into retirement homes. There's no cap on how much they might pay for this care, and no way of managing it yet before they retire. Maybe I've missed this policy discussion from being overseas, but within 20 years, dementia is expected to be the 3rd largest expenditure for health and residential aged care spending in Australia, at about 1% of GDP per annum. One report on healthcare costs suggests that spending on dementia will surpass that of any other health condition by 2060. By the same token, the UK has actually just put in place a policy solution for health insurance, which, while early days, and have been discussing it for years, does at least give members there some options. So despite being far-sighted and well advanced in cutting DB early and in introducing compulsory DC, Australia seems now to have fallen behind, in my view, and it needs to react to the new low interest rate environment, and also to the healthcare and ageing problems that things will inevitably bring in pensions. So moving on to compare policy differences between the two countries. This slide summarises the policy framework for the two countries. As discussed, contributions 9 in Australia, auto-enrolment going to 8% in the UK, so pretty much the same. Taxation, they're both tax-advantaged. Tax-free in the UK, much nicer, but still tax-advantaged. Differences arise at retirement and later. In the UK, the basic state pension is not means-tested, which means that most people get it if they've worked. The individual is limited, though, to taking out only 25% of a private pension pot in cash at retirement. In addition, unless someone has an income from another source of around about $30,000 per annum, pretty hard to get really, they are forced with the remainder of their balance at retirement to buy an annuity policy. This transforms their pot of money at retirement into an income for retirement. This, of course, automatically manages their longevity risk and ensures that they do not fall back entirely on the state. In Australia, I find it rather odd that after making compulsory contributions into retirement schemes and then allowing these monies to grow in a tax-advantaged way over time, that the government policy allows members to take all cash on retirement and to spend it all, if necessary, with no penalties or deterrent. In fact, the member with a small balance, as I understand it, is positively incentivised to spend it and then rearrange their affairs so as to get a part or full pension. Unlike the UK, where it's not means tested, this seems at odds with the intent. Final point here is about an income stream in retirement. Compulsory annuitisation is obviously a very unpopular subject, but it seems to go hand in hand with compulsory contributions, and it seems a natural corollary. The UK government's had it for years, and obviously introducing it here would be incredibly unpopular. But even if this is unthinkable, then preventing 100% cash removal is something that, above a threshold level, should probably be considered, and maybe, in fact, a change that's planned for the future. If not, then the system seems self-defeating. Incidentally, the OECD recommends that 20% be the maximum amount that should be able to be taken out as a lump sum, and particularly where you've got compulsory contributions. So moving on to a key difference in the UK, a major difference is obviously the absence of member choice of scheme in the UK. You can't ask your employer to contribute to another pension scheme. They do it for you, and they do it in their scheme, and that's that. So is that a terrible deal? For Australia, who's embraced choice and who gives people sort of the choice of where they manage their money, perhaps you'd consider that terrible. But in fact, it does have certain benefits. Because you can't switch, there are no league tables produced of return or fees or competition between schemes because you can't switch. Instead, pension funds also don't look over their shoulder at what others are doing, the terrible peer group risk. And instead, trustees try to understand both actuarially and from other data what their members want and try to provide a mixture of services to their own peculiar mix of members. DC members are also far less likely to be offered a one-size-fits-all default policy. So maybe this is terrible, but it does do away with some parts of the super system which others are pleased not to have to deal with. So I'd now like to move on to some things in DC that I think would be useful in a DB that I think will be useful in a DC environment. Firstly, it appears to me that a product designed to last for an average 23 years should best be described to the member as an income stream and not as a lump sum. As a DC trustee, I was very keen to ensure that my members, when they logged on, received an income replacement value on the member website rather than a pot of money estimate. By an income focus, I mean that pot of money should be expressed in terms of the current proportion of either current or final salary. By switching to this focus, I think super schemes will assist the member and give them a direct comparison to their current lifestyle. If instead of logging on and seeing a balance of $200,000, which most people think is quite significant because it's a certain proportion of a house value, they actually said that they'll only be getting 14 or 15% of their current salary, then that might be enough to prompt members into thinking that they're not saving enough. Even if you add on $20,000, so if you have a pot of $200,000 and you add on the state pension as well, that only brings the income replacement up to 40% of average salary. Considering that the OECD minimum target replacement is 70%, it's becoming clear that we haven't accumulated anywhere near enough. I don't know what your members would say if you said, what's your income from your pot, what's your income going to be in retirement? But I believe that super funds are the best placed organisations to educate the members about this. The second thing is benchmarking. Having got used to that, benchmarking is not of assets. Benchmarking is of liabilities and assets and the gap between them. Having got used to being told that their pot of sum is actually an income, this allows the member to then define what income they need in retirement, and then we can provide tools to analyse the inevitable gap that will appear between what they currently have and what they may get if they carry on doing what they're going to do. The gap analysis or glide path, which some people were talking about earlier, gives you a framework as you move along that path as to whether you're getting closer to the goal, what you need to do when you get there, and how risky your current investment strategy is in the light of the benchmark that you're using. The advantage of this glide path analysis is that it maps out for you the journey that you're planning to take. Whether it's how much more you need to save, for how long, or how much risk you need to take, basically it sets out the path to full funding or meeting the income objective in this stage. In my view, just telling the member the size of the pot and what return they got last year is akin to sending someone out on a journey without a map and with no idea of their final destination. We're just not equipping them with the basic raw materials to make that journey. And even though we know we can't be precise in our forecasts, to not prepare them for this journey with a map, such as a glide path, seems inappropriate at the least. The final thing from DB that might be useful in a DC environment is giving people the tools to manage longevity risk. Company sponsors in the UK are able to use the market mechanism to transfer away longevity risk, offloading it onto another participant, generally life insurance companies. While this is not an easy market to understand nor to analyse, I don't presume that the individual member has the skills or desire to manage this risk either. And yet in a DC system, the members have it totally on their plate and they can't get rid of it and they don't have tools to do anything about it. So how can we help them? One way for them to offload longevity risk is, of course, to use the insurance market for longevity, which is, of course, annuities. I know that this is not developed well here in Australia, and perhaps it needs a push from super funds or from the government, but I believe that these markets do react to demand. And like other insurance markets, life, cars, etc., the data already exists and needs a method of resolving them and aggregating them. The UK government's example of forced annuitisation at retirement is definitely suboptimal, but it provides a start. I think that some changes of the rules about how much cash you can take, together with the development of a variable annuity, combined with perhaps income drawdown and deferred annuities, might be an eventual goal for the average member when they've been saving for 40 years. This will give them the tools to manage and offload their risk. So as you can see, I think that tools commonly used in DB schemes can be brought to bear in DC strategies successfully to help the member better manage their risks that they've assumed and they're probably not already aware of. Super funds are, as agents of the members, are best placed to provide these services. Moving on to some investment observations. One thing that does trouble me is the lack of customisation of the default option. The default strategy generally has a lot of people in it because members are disengaged and includes those people in it who need the most guidance. In my scheme, we had 90% of the members in the default scheme, and it was the main focus of the trustee work. As far as I can tell, in Australia, the DC default option remains this one-size-fits-all, regardless of choice, regardless of age. In my view, this is a poor approach across age groups, because a 25-year-old does not need to be invested identically to a 59-year-old when they've got when they're at different life stages. I know the industry is developing life cycle investing here, and I'll just take you through an example that we use in the UK for the schemes that I was running. Basically, we divided people into three types of investors. Protected growth were people, the first group, up to age 42. These people are building balances, and we wanted to encourage them to contribute more. Because they can opt out, we wanted to give them a protected growth strategy rather than just an all-out growth strategy. In this early stage, it hardly matters what the member is invested in, because their contributions are what matter more than the investment strategy. The grey line here is the annual contributions, and the total return line is the light green line. As you can see, in the early days, there's hardly a gap between them. So what you have to do is to not scare this member off, to give them the information about the savings plan that they need to take, and to not to cause them to stop contributing at this early stage when balances are low. You don't want to switch them off. Next stage is the diversified growth stage. This is aged between, say, 40 and early to mid-50s. Here the balance has become a reasonable size, and now investment returns really do matter, much more to the total return than contributions. But there is still time to recover losses, so a diversified growth strategy is the mainstay of this strategy. Finally, at some point, usually 5 to 10 years before retirement staging, the asset allocation switches into risk, which de-risks into either cash, corporate bonds, or index-linked, but ideally index-linked prior to part annuitisation. Income drawdown is also an option for those that have large balances, of course, but for those lucky people, total de-risking might not be the answer as they approach retirement. But for most members, the average members in my scheme and in many schemes here, DC balances are still too small, and de-risking seems appropriate when you approach a staging point. The second observation that I had about DC plans was how differently they're managed compared to DB schemes. They both have a long-term outlook. If you have 10 plus years in each phase, then there's plenty of scope to invest across a diverse range of assets. In my view, a 10-year plus investment horizon requires a range of asset classes and a range of liquidities and premia to produce a result. That should involve both public and private markets. I wonder then why the Australian version of growth always seems to be over-reliant on equity risk. The Australian pension scheme has the highest equity allocation amongst any G7 nation. More than that, even through and after the GFC, this allocation has hardly budged. Apparently from 07 it was 55, and in 2012 it's 54, so it's gone down 1%. Over the same period, the UK's equity allocation reduced by 9%. Now, I'm well aware that the Australian equity market does have advantages in dividend imputation, high dividend yield. Australian equities have outperformed the world, and so there are some advantages that cause people to have that home bias. But I just wanted to recap the following slide on you, which I'm sure you've already seen before. In fact, Greg showed it earlier. We all know that capital allocation does not equal risk, and we all know a 60-40 fund with 50% in equities is really a 96% risk equity portfolio. So we were talking about this before I left 7 years ago, and yet the average growth fund still contains, the average default fund still contains this equity risk. So I must admit to being confused by this, and I wanted to talk you through the example that we would use in the UK with our members about why 100% equities could be improved using a range of assets. So this shows a range of stochastic modelling demonstrating the range of outcomes that a member can expect if they invest 14% of their salary for 40 years under 3 different investment strategies: 100% equities, 100% DGF, and 50-50. Success here is shown on the basis of the replacement final salary at retirement. And before you get excited, this also includes the UK state pension, so this isn't only what you'd get if you save 40%, so the 70% there includes another benefit. In my view, this demonstrates how a 50-50 DGF plus equities is a better option compared to 100% equities. Of course, you do give up upside. The 100% equity offers the best if everything goes right. But not only is the median income rate replacement ratio roughly the same, 70, 72, 69, but more importantly, the downside risk is much better managed, both at the minimum level of replacement income as well as the 1 in 10 chance. This notion of smoothing the journey, giving away some of the absolute upside but keeping the median similar and reducing the downside, seems to me to be an attractive trade-off. In this world of volatility where clients prefer security in retirement, a consistent approach with less downside seems suitable. The second reason that I think DC is treated like a second-class citizen is in breadth of investment. I believe that there's evidence of an illiquidity premium that rewards illiquidity, and as a long-term investor we should play to our strengths and assume illiquidity if we have the appetite to do so. DC clients, and this comment may be more attached to retail funds and industry funds, but DC clients somehow are second-class citizens because they do not get access to a range of illiquid assets in their investments. If I just show you on a risk-return lens, this is a traditional portfolio that would be produced for a typical default scheme. And on a risk-return lens, this investment strategy does look diversified. Because you've got assets across the whole range. So you would appear on that basis it's okay. However, when you change the lens through which you view the investments, we have a different story. The left-hand chart was the one that you looked at previously, but the chart on the right has changed only the vertical axis to be liquidity rather than return. And you can see you've got more, less, and medium liquid assets shown. And when you see this, the assets on the left-hand side all fall into the most liquid category, i.e. daily priced category. So there's no illiquidity premia available for members in those schemes. The exception to this may be property, which can either be accessed as direct property, which is the very illiquid one down the bottom, or as listed property. So maybe some people have direct property, but my guess is most people proxy property with listed, and hence what looks like a diversified portfolio is in fact a total liquid portfolio with a lack of diversification. The right-hand chart on this slide, I've added in some of those gaps, some of those medium liquidity and less liquidity asset classes, things like high yield, absolute return, emerging markets, frontier markets, infrastructure. I'm not saying that all of these assets should always be in a DC portfolio. In fact, I prefer an opportunistic approach, because if you're pouring in assets to fill up buckets, you always tend to have a bad outcome. But not to have access to these less liquid investments seems to be disadvantaging DC investors. Does not give them an opportunity to play to their strengths, which is long-term investing. As head of alternative assets for the DB scheme in the UK, I invested $1 billion and produced 5-year numbers that beat equities hands down. 16% return with 6% vol and low correlation to equity and bond markets. This performance was only available to our DB investors, and I, for one, was very disappointed that we were not able to bring similar returns and investments to our DC members. Before I finish, I'd like to say a few words about next generation pensions and how the debate is being framed in Europe today. Today's pension industry is obviously still very immature, and it's still improving. We've only been around 20-25 years, although obviously some schemes have been around longer. Within the past 20 years, we've already moved from DB to DC, and so where are we going next? Firstly, I think there's a recognition that the individual is very ill-equipped to handle some of these risks, and that they don't even know they have these risks. Whilst DB gave all the risks to the employer, DC gives all of these squarely to the member. In Europe and the UK, there's an objective to share the risks more evenly between members and the employer. In continental Europe, especially Holland, it's always been more risk sharing. Expectations are that the employer will aim to do things, but if they fall short of the target, then both the employer has to put in more money and the member has to accept less. The UK is considering exploring a defined ambition approach by the Steve Webb, the Minister for Pensions, which also shares risk between the two parties. A version of this is DB-. So the objective is to try and make sure that it's not just totally on the member, that there can be some sharing, and that companies can use their retirement incomes policy as an attraction for staff, so that people are attracted to those with the best schemes. Obviously, DB's dead, but we don't think that DC is necessarily the best answer for the member. Finally, the UK and the OECD are both doing work on guaranteeing minimum outcomes for DC members. For example, the OECD pension report produced last year has quite a bit of work on how much these things would cost. An inflation-indexed capital guarantee costs around 5.5% of contributions. So that would give the members a guarantee that they would get their contributions back plus inflation linking at the point of retirement. I'm not by any means saying that this is the best outcome, but it seems to me that rather than just saying to the member, well, we're going to give you whatever we think is best, whatever it gets at retirement, just doesn't really seem to be a good service. An ongoing capital guarantee costs much more, estimated to be around 18%. So obviously these things are being thought of, and I know that the UK government and Nest and other people are thinking about how can we guarantee a better performance for our DC members without costing the earth. So in summary, whilst the UK and Australian schemes have had similar origins, they've developed down very separate paths of late. Australia is now focusing more on the decumulation phase and annuities and longevity and all the stuff being thrown around in the session earlier, shows that you're thinking very hard about that, and that's very good. But I do think there are some ideas from DB that may be useful for DC, and I think it'd be really great for super schemes here to be showing people an income focus, not a pot focus. I think investment strategy has evolved beyond one size fits all, and there are projections that the lifetime or life cycle and target date preferences in Australia will be a large part of the market in a few years' time. Policy changes may also be needed to counter the perverse incentives that seem to exist in Australia. The current system only makes sense if you think that the DC 9% was only ever designed to replace the state pension scheme, which when I did my ASPA exams many years ago was actually thought to be the reason why it was there. It's to help the government, not to help the members. And we've sort of seen that we need to save more in any case. And next generation pensions will definitely also be different again. So in summary, in the words of Henry Ford, you always need to keep on improving. The Australian cricket team, after a decade of beating the world, has finally been caught up and overtaken by the English team in the past 7 years, sad to say. It's about time that this gets corrected. And it's about time that I think Australian super schemes can work to improve things, embrace new ideas and get in front again. For Australian super schemes, Perhaps this should be reinterpreted as static is the new risk. Thank you for your attention.
Going to make a few remarks loosely around a theme of long-term investing and ways in which we might think about it. But I'm primarily interested to hear from you, I guess, as to whether you think I'm getting it wrong, or ways in which you've already solved the problems which I'm confronting, which seems entirely possible. So, I need to press the button. So as Steve said, I run the Railways pension scheme in the UK. The badges there, they're the badges of august old railway companies. And we carry a lot of heritage and history with us. It feels like a long-term institution in that sense. We even have our own police force, that's the one on the right. So don't mess with us, we'll put you in jail. But to give a bit more detail on the history, the railways started in the UK in 1825. There was a railway opened between Stockton and Darlington, and interestingly, our main office is in Darlington. So it's got a lot of heritage for the pension scheme there. I won't inquire too closely what was happening around here in 1825, if anything. I'm really cruising for a bruising, aren't I? But the railway employers in the UK, they got some things wrong, by the way, and there are disadvantages to being first up with things. So we gave the world railways just as we gave the world cricket. Did I mention cricket already? But we didn't quite get it right, so the tracks are probably just a bit too narrow, but everyone else has had to use the same gauge. We definitely got our tunnels too small, and as a result, whereas on the continent of Europe they can have really big freight trains and double-decker passenger trains, we can't have any of that in the UK because we innovated too soon, and sometimes it's best to wait for someone else to do that. So, but we got into pensions pretty early. So we had the first Railway Friendly Society in 1848, when the rest of Europe was deposing its monarchs, and the railways were great employers. Not so great for the shareholders, mind you. If you ever come to my office in Darlington, by the way, it's just an industrial town in the north of England, so I'm not particularly recommending it. But our office looks like a replica of Buckingham Palace. There was something about the railways. They were really self-confident in the early years, and they built themselves lots of lovely offices and big stations and hotels. The shareholders all lost all their money, but there could be a lesson there that is relevant to the modern day as well. Financially, as I said, they weren't a great success over most of their life, and they ended up being nationalised in 1948. But you know, times changed. Wheels turn, and in 1994 the Conservative government of the day decided it was going to privatise them, and that's how we created the Railways pension scheme. It's an industry-wide scheme, buyed into the fact that we had one big scheme and we split it between a lot of employers. So there you are. In the UK, to create an industry-wide super, all you need is 46 years. Other countries seem to have a better model. You seem to have lots of these things over here. How did you manage to do that? You must have started from a different place. So I do feel I am running an industry super in all but name, however. Our scheme is sectionalised between all the different railway employers in the UK. If you know anything about the UK's railways, there are around 20 companies that run trains and another 120 or more that support the infrastructure. And they all have a piece of my scheme, so we have to unitise the scheme. So it probably looks not that different from some of the supers over here in that sense, even though most of the benefits are DB. As Steve said, it's around 19-20 billion pounds, third of a million members. Strangely for UK DB, many of my sections are open to new entrants as well as accrual, and that's primarily because everyone assumes that the trains will continue to run. and the employers that run them have franchises from UK government, and at the end of the franchise, they get to give the pension scheme back to the government, who then passes it on to the next franchise holder. So Bev's absolutely right about the trend in the UK. I don't think there are any FTSE companies that have open DB schemes anymore, apart from the ones that happen to be in the Railways pension scheme. So therefore, we do have relatively high equity allocations within those sections of the scheme, although along with the slide that Bev showed, we've been trying to diversify that risk as far as it's possible to do so. But most of our other sections which are closed, I think the story that Bev painted of moving away from risk and into ever more expensive index-linked gilts, it's a trend which we fight against, but we haven't managed to completely avoid. So about investing for the long term. I mean, our history as an investing institution, I can't go back to the 1840s, but I can tell you what's happened over the last 40 years. In the 1970s, the Railways pension scheme in the UK was very celebrated for investing in works of art. It was only ever 3% of the assets, but it certainly got a lot of press coverage. And why did they do that? Well, the scheme's always been inflation linked in the pensions it's given, and there were no inflation protected securities in those days, and it was just seen as a potential store of value. So were they far-sighted and innovative, or were they just lucky? I think they bought everything there was to buy, and it was kind of fortunate that the Japanese investors got interested in Impressionist paintings in the late 80s. So over its lifetime, that part of the fund returned inflation plus 4% per annum. So it did a good job. I wish I could be so bold and lucky today. Other things we've done, though, I think have looked a bit more mainstream. So, for instance, the 1980s theme was all about outsourcing. This was true of the UK in general, and my employers did the same thing. This is before my time, by the way. So we went from in-house management to having nobody in-house that knew anything about investment in 1987, and appointing 4 external balance managers. It took 2 years for them to realize that actually they needed to have somebody in-house who knew something, and they appointed an investment director. And we still have all the assets outsourced, but we're now up to about 50 people that might call themselves investment professionals. So there's something about having enough critical mass to be a self-confident organization. I wouldn't say we're there, but you definitely need it. The theme of the 1990s was specialization, so I told you we had 4 balance managers for a while. I looked in our report and accounts just before I came out here, and I counted 86 managers, which feels like quite a lot, even for 20 billion. That's not including the ones that are hidden because they're underneath layers of funds or managers of managers, although we try not to do too much of that stuff. By the way, I don't have a down on professional fund management. They're very much the solution, not the problem here. But we just need to be intelligent about the way we interact with them as partners. In the 2000s, I think Bev's already called out the drive towards liability-driven investment effectively. And for the UK, that included an ill-judged dive into infrastructure. I came over to Australia 12 years ago, I think, and met a few super funds. And I was impressed that they all had this investment in something called infrastructure, which frankly, I was a bit wet behind the ears. I hadn't really heard of at the time. But lo and behold, 4 years later, or 5 or 6 years later, in the UK, we were all buying infrastructure funds like they were going out of fashion. And of course, it was your banks that were selling them to us in the main. So a good trade for you all. Because this was just before the global financial crisis hit. And we thought we'd bought illiquid but inflation-protected streams of income. And of course, the inflation protection had been passed off to someone else to back inflation swaps that the investment banks had sold elsewhere. We were left with highly leveraged equity risk, effectively. 2008 wasn't a good time to have that. I'm painting a rather one-sided picture here, you understand. It's not all been bad. We've had quite a nice investment in one of your toll roads, for instance. But that's the sort of picture of the way the UK has reacted to things. There is a bit of a herd instinct that applies even amongst larger institutions, I would say. We think we're smart sometimes, but we're not always smart. And what's the theme now? Well, it's diversified growth, and who knows, smart beta maybe is the buzzword. And why are we in diversified growth? Well, for my trustees, that's really also a response to the financial crisis. We thought we knew that we were running an equity-oriented portfolio and that things wouldn't go well when equity markets did badly. But frankly, my investment committee weren't prepared for what happened in 2008. And we've really taken quite significant steps since then to diversify much more. But this also looks like hindsight goggles management by one way of looking at it. So is this really the solution? Or are we going to find that actually it was just the next fad? I'm asking you the question here genuinely, send me some answers in, please. It's very important to have mission clarity, though, and I think that's the thing that I found my investment committee lacked in 2008. And that's really a key element of a self-confident investing institution that can actually do a good job for the long term. What I've put on the screen now, these are 12 factors for long-term institutions, which were developed by Professor Gordon Clark and Roger Owen. Roger Owen's probably known to some of you, I guess, UK-based investment consultant. Gordon Clark's one of your own, I think, although he plies his trade in the Oxford University Geography Department. And they did some great work to come up with some good headings for us to follow. I've praised a few of them, but I hope they make sense still. And you'll see mission, clarity, and strong beliefs are right up there. And I would say that's what we're trying hardest to build into our organisation now. But it does involve a lot of self-questioning. As you can tell, I'm in a reflective frame of mind. I am still awake, aren't I? I'm not dreaming this. Okay, good. And if you prefer a shorter version of that, then Keith Ambakshir, who's a Dutch-Canadian expert on pension governance, also calls out aligned interests, sensible investment beliefs as being key. But another piece of both these pieces of analysis is around being right-scaled, i.e. having enough resources to actually be able to ask and answer the sensible questions. I try not to major on the competitive compensation bit because that always feels like special pleading. Clearly I like getting paid. I presume most of you do as well. But I wonder if compensation seems to be an issue around the UK and North America, but I wonder if that's as much about geography and the existence of large financial centres there. When I speak to Dutch pension funds, there's no question they're at the forefront of intellectual thought in our field. But there seems to be a much more even playing field in terms of remuneration between the pension fund executives, people that work on the commercial side, and indeed academics in Holland. And I wonder if that's just says something about Holland's place in Europe and the fact that there aren't the same temptations, maybe. I may be talking gibberish, but it seems to me they have a more sensible approach to allowing cross-fertilization between different parts of the industry. And maybe that's also true over here. Tell me if I'm wrong. Now, I said I was trying to talk about long-term investing, so I always reach back to gurus of the past. Keynes said the long run is a misleading guide to current affairs. In the long run, we're all dead. And speaking as a pensions manager, I rejoice in that statement every day. If I couldn't rely on my members to die regularly, then my job would be really futile. And a variant on that is the market can stay irrational longer than you can stay solvent, and that's also frequently the case in institutional investment, I find. I guess he was saying, don't get too anchored. This is a picture of the English fleet getting in amongst the Spanish Armada in 1588, by the way. And I believe what happened then was that the Spanish fleet was at anchor somewhere off the French or Belgian coast, I'm not sure. Except it wasn't called Belgium then. And the English sent in fire ships, and so the Spanish had to cut their anchors off. And as a result, they couldn't stop when the wind blew, and they all ended up going all the way around Britain and down the other side in complete disarray. And that's how we defeated the Armada. I'm not sure what I was trying to say with that story. Well, I think anchors can be a good thing. I mean, if you want to have a long-term perspective, then surely you have to have some sense in your head of what the right level is for things. So I started in this industry in 1986. So in my head, equities always return double digits. Index-linked bonds should yield about 3% real. And long bonds probably more like 13.5%. And I have little daydreams where I imagine we've gone back to that scenario on a regular basis, and we're going to need to for most UK funds to get back into 100% solvent position. But actually, that may be the way out for the UK economy as a whole. We have a bit of a national debt problem, as you may be aware. And one way or another, the government solution, nobody kind of says it, but the only way the books eventually balance, it seems to me, is that we devalue the currency again, something that we seem to have made a habit of. Last time I came to Australia, I'm sure I got more than $3 to the pound. You must be doing awfully well over here compared to us. So, long-term decision-making. Steve mentioned I was involved with John Kay. When you Google things, you don't always get the right answer. So this John Kay isn't the right one, I don't think. This one actually invented something called the flying shuttle in 1745, which was pretty important for making weaving faster, I think. If Australia grew on the back of its wool industry, then you have this person to thank, amongst others, probably. But this is the John Kay that I was involved with, who's a visiting professor at LSE and previous head of the Institute for Fiscal Studies in the UK, regular FD columnist, etc. And he was asked by the government's business department, known as BIS, to actually investigate whether there was a problem with short-termism in the UK. And we had great fun analysing the problems and coming up with some solutions. We produced a nice report. Well, when I say we, John wrote it all himself, and he writes much better than I do, so that's probably a blessing. If you would like to read it, I think it's probably still available on BIS's website. The reference is there. 112 pages, but actually quite a good read for a government document. The market reception was that it was a fantastic analysis of the problems, possibly a bit weaker on the solutions. That's the problem. When things are hard, it's kind of hard to solve them, isn't it? But we did come up with 17 recommendations, and I'm not going to tell you what they all were, because that would eat into cocktail time. But just one or two flavours, I suppose. And the single strapline would be, we need to remake the value chain. Things have got out of control to the point where markets are not operating for the benefit of either the companies whose capital they're supposed to raise or the investors who invest in them. And clearly, from the point of view of a long-term investor, we want to ensure that the markets are running for our benefit. So what can we do to actually give better incentives to management? One of John's themes was, he has a certain academic bent, right? So he came up with this phrase, meta fund management. And companies like ICI and Marconi in the UK, you may be aware they don't exist anymore, but they indulged in meta fund management. They bought and sold other businesses to the point where they destroyed all value. So how do we ensure that management has the right incentives? Professor Roger Martin at the Rotman Business School in Toronto is quite strong on this subject. He believes that all executive compensation is a waste of money because it's just completely misaligned. And I'm inclined to agree. And the analogy he uses is to do with North American football, which I don't know anything about, although slightly more than I know about Aussie rules. And the analogy he makes is that the CEO of a company is like the quarterback on a football team. The quarterback's the person who, I think, stands in the middle and directs the play and throws the ball for someone else to catch. Tell me if I'm getting that wrong. So he's the most important player. But the North American Football League are very clear that if you're playing the game, you have to concentrate on trying to win. So you're not allowed to bet on the outcome of the match if you're playing the game. You're not even allowed to bet on yourself to win. Whereas in corporate management, we give CEOs large amounts of stock options, which are effectively bets on the outcome. And therefore they spend all their time trying to work up the stock price rather than the underlying value of the company. You get the picture. I mean, Professor Martin would say that actually it's better not to incentivize them at all, just pay them a good salary and leave them to get on with it. We can argue about that. Equally, it's important that our portfolio managers are fully engaged. And you'll appreciate that if I have 86 fund managers, there's not such a strong link between what I would like each of them to do in terms of managing our underlying securities and what they actually do, as if we had fewer. So one of Professor Kay's proposed solutions was to have more concentrated portfolios, more fully engaged managers, more joining up between the engagement part of the fund management businesses and the actual security buying and selling. But more fundamentally, I suppose, we'd like to rebuild trust throughout the investment chain. I mean, it's clear to me that the fund management industry is on the good guy side here, but I can't really say the same for some other parts of the business. And maybe as institutions, we need to be a bit more questioning about the practices that we condone or perhaps even participate in, that we may persuade ourselves aren't too detrimental for us. But if you really think about it, what are they doing to help us? So high frequency trading, someone's allowed to plug their computer in closer to the exchange computer than I can and make profits out of that, supposedly to give me the benefit of more accurate pricing. But I don't need accurate pricing on a microsecond by microsecond basis. And those profits are coming from somewhere. It seems to me they must be coming from end investors one way or another. Again, tell me if I'm wrong. I don't proclaim to know all the answers here. I've even started to wonder about stock lending, which I've routinely said, well, it's fine, it's just a peripheral extra bit of income, and we're pretty conservative about the way we do it. But every now and again, our stock does get lent to someone who votes for something that isn't beneficial to our interests. Why are we allowing that to happen? Shouldn't we just be more muscular, more clear about what we want from the markets? So, this stuff's all easy to say, but unless we can actually all do it and be collective and work together and really be self-confident about it, it's going to take a long time. I think it's going to take a long time anyway. The pendulum on these things swings very slowly. I was going to say it's probably 30 years that the trend's been running away from us, so it's probably going to take 30 years for it to swing back. But maybe even that's not long enough. I mean, I think it's probably about 60 years since someone wrote a book called Where Are the Customers' Yachts? I think it was called Fred Schwed. And that was about the fact that self-explanatory really, New York Harbor was full of yachts that belonged to bankers. There weren't many that belonged to pensioners. So it's not a new thing, but we kind of need to change the rules a bit and try and ensure that we make things a bit better for the long term.